Dear students, today we are going to discuss about Introduction to Managerial Economics. So we need to know first of all what is economics in general and what is microeconomics, macroeconomics, and then we can know the nature, scope and significance of managerial economics. And afterwards we need to know about the functions of a managerial economist and what role he plays in the management team. These are the topics for discussion for today's class. So let us begin with introduction to the simple definition of economics. We are all aware that several economists have defined economics in a different ways. Starting with Adam Smith, he has given Wealth of Nations, an inquiry into the nature and causes of wealth of nations, his famous book, and in his book he has defined economics in terms of wealth, creation of wealth and distribution of wealth. And later economists like Alfred Marshall defined economics in terms of welfare, human activities and human welfare. And later Robbins defined economics as in terms of scarcity of resources. So a general widely accepted definition we can have, that is we may define economics as the study of allocation of scarce resources among alternative uses. So it is the simplest definition and widely accepted definition for economics in general. That is, it's a study. Economics mainly deals with the study of allocation of scarce resources among alternative uses. And if you carefully follow the definition, you know that the resources are always scarce, and they are not only scarce, they have alternative uses. That means the resources at the disposal of an individual consumer or an individual producer or a firm or even nations are always limited. And they are not only limited, they have alternative uses. So when resources are limited and when they have alternative uses, naturally one need to choose the best alternative. That is the subject matter of economics. From this we can understand that economics mainly explains it deals with the allocation problems of individual consumers, producers, firms and nations. So take the case of an individual consumer. We know that the amount of money or resources at the disposal of an individual consumer are always limited, and he has abundant wants. So naturally any rational individual wants to maximize his satisfaction out of his limited resources. He will choose those items which bring him maximum satisfaction or maximum utility or satisfaction. Maximization of satisfaction is the goal of an individual consumer given the limited resources. Similarly, in case of a firm, the resources at the disposal of a firm are limited and they have various alternative ways of spending the money. Naturally, the firm has to select the best way of allocating limited resources. Take the case of a nation. Generally, a nation, what is the goal of a nation? It has to protect the welfare of people. So it has to strive for the welfare of people. The resources are allocated among the developmental activities which bring the maximum welfare to the people of a country. Coming to the individual firms, what are the goals of a business firm? What business firms normally aim at? While allocating the resources, you should have a goal. For example, we have seen that individuals, they want to maximize satisfaction. Similarly, firms or producers, they want to maximize something. They want to maximize profit, for example. The widely held objective of a business firm is maximization of profit given the limited resources at the disposal of the company or firm. So this is a widely accepted goal of a business firm, and later economists, they have developed alternatives to profit maximization because there are certain limitations of profit maximization objective. For example, the profit maximization goal presumes the prevalence of certainty and perfect competition. And we know that in real world perfect competition is not possible. And also certainty, future is always uncertain, and a manager has to face uncertainty while taking decisions. So in the absence of these two, what is the alternative goal? Profit maximization can no longer be the goal of a business firm. Another problem is there are different concepts of profits. What is the profit, meaning of profit? Short-run profit or long-run profit? Or profit before tax or after tax? Or whether you want to maximize earnings per share or profit after tax? So these are some of the controversies. And so the alternative to profit maximization, which was widely accepted, was wealth maximization goal. The goal of a manager is to maximize the welfare of the shareholders. Being welfare is a very abstract word. What do you mean by welfare? So it is better to define in terms of measurable terms. It was defined as the wealth maximization as the reasonable objective of a business firm. Even wealth maximization also reduced it to maximizing the value of the business firm. If by different decisions like financing decision or investment decision or production decision or marketing activities, if a manager is able to maximize the value of the firm reflected in terms of market price of the share, the wealth of the stakeholders is maximized. So that is widely accepted objective of a business firm nowadays. And then there are other economists who have proposed other objectives of business firms like William J. Baumol. He developed the model known as business firms, they try to maximize sales revenue subject to attainment of reasonable profit. So the managers, they have a target, they have to reach a targeted rate of profit, and they aim at reaching that level of profit, and after reaching that profit, their aim is to maximize sales revenue subject to attainment of reasonable profit or targeted profit. Later economist Williamson, for example, he developed another model known as the managerial utility maximization. So according to this model, managers, they try to protect, they try to reach the targets, and once they reach the targets, they try to satisfy their own ends, their own goals, their own certain things which give them pride, like say power to invest, the number of people working under him, like that. Those things, they give maximum utility or satisfaction to a manager, and manager, he tries to maximize those things. But here also once they reach the targeted profit. And an altogether different model was developed by Herbert Simon, that is called satisficing behavior. We no longer maximize, we satisfy with a reasonable rate of profit or reasonable level of growth or sales or whatever may be the thing. Firms, they satisfy after reaching a targeted performance. That is called the satisficing behavior of Herbert Simon. And there are two more economists like Edith Penrose. He says that growth maximization should be the goal of a business firm, or size, maximizing the size or growth. Similarly, Rothschild, he says that long-run survival, it's not the short-run case, long-run survival of the firm must be the objective of a business firm. So we have so far seen the definition of economics, and we have seen that individual consumers or business firms, they try to maximize with limited resources. So economics is the subject study of allocation of resources. Now let us see the difference between microeconomics and macroeconomics. The two main branches of economic theory are microeconomics and macroeconomics. What do you mean by microeconomics and what is macroeconomics? Microeconomics in general is nothing but the study of individual behavior. The unit of study in microeconomics is individual, be it individual consumer, producer or firm or industry. So the focus is on the consumer's equilibrium or producer's equilibrium or firm's equilibrium or industry equilibrium. So in microeconomics, the unit is very small and it is individual. Then what is macroeconomics? Coming to macroeconomics, here the unit of study is large, that is economy-wide aggregates. We focus on economy-wide aggregates, that is determination of national income, output and employment. Changes in aggregate economic activity known as business cycles, and changes in general price level known as inflation, deflation, and then say total savings, investment, determination of rate of interest. These are the topics of macroeconomics. So we deal with economy-wide aggregates like national output, national income, total employment, general price level, changes in price level, and then aggregate economic activity, changes in aggregate economic activity. These are the topics of macroeconomics. And moreover, not only the determination of general aggregate economic activity, and we have also seen that there are certain factors that cause changes in aggregate economic activity and also changes in the general price level. Then how to correct the disequilibrium or these fluctuations in aggregate economic activity or price level. So what policy measures are available to the government to control and regulate these changes? So there are two policy measures. One is the monetary policy and second one is called fiscal policy. And we know that the Central Bank of India, in our case Reserve Bank of India, has power over the money supply. It can regulate the money supply in the economy by way of bank rate or open market operations. Depending on the need, it can increase the money supply in the country or decrease the money supply in the country. That is called monetary policy. So that is the tool to regulate fluctuations in aggregate economic activity or inflation or deflation in the country. Depending on the need, it can sometimes increase the money supply or decrease the money supply. That is called monetary policy measure. Second one is a fiscal policy. So this is nothing but the expenditure and revenue methods by the government. For example, by way of taxation, the government can control the money supply in the economy. It can squeeze the money supply. And similarly, if the government wants to dump money into the economy, naturally it can undertake developmental projects, roads, construction of roads, buildings, infrastructural projects, ports, etc. so that money supply in the economy will be pumped. So that is how fiscal measures are taken, just to regulate the aggregate economic activity fluctuations and price level fluctuations. Then, so we have seen what is micro and what is macro. Now let us see what is managerial economics. Economics which is useful to a manager is known as managerial economics. So there are certain tools, concepts, analytical tools which are relevant to a practicing manager, and this body of literature is known as managerial economics. So economics in the service of a business executive is known as managerial economics. For example, Donald S. Watson, he says that price theory in the service of business executives is known as managerial economics. Price theory means nothing but microeconomics. Microeconomics is called as price theory and macroeconomics is called as income theory. So microeconomics in the service of business executives is known as managerial economics. And then we can modify the earlier definition of economics and we can derive a definition for managerial economics that is given by William Haynes, Motte and Paul. For example, managerial economics is the study of allocation of scarce resources available to a firm or other unit of management among alternative uses. So we have seen the definition of economics, and that is slightly modified and made applicable to a firm, the allocation problems of a firm, that is called managerial economics. How a firm allocates its scarce resources among alternative uses, that is the subject matter of managerial economics. And Milton H. Spencer, he defined managerial economics as integration of economic theory with business practice for the purpose of facilitating decision making and forward planning. So a manager is supposed to discharge the major function of decision making, and managerial economics helps in taking rational decisions, correct decisions. So, and one more definition is managerial economics is economics applied in decision making. It is a special branch of economics bridging the gap between abstract theory and managerial practice.